Okay, let's jump right into this explainer. As an investment analyst, I absolutely love applying time-tested philosophies to modern stocks. So today, we're taking all the raw data, SEC filings, earnings transcripts, market reports, the whole shebang, and we're running TE connectivity through a rigorous financial gauntlet. We'll be evaluating this company through the distinct, legendary lenses of Warren Buffett, Peter Lynch, and Benjamin Graham, right before we subject it to our own discounted cash flow and a few alternative valuation models. It's going to be fun.
Here is our roadmap for today. We'll start with a company snapshot, look through the lenses of Warren Buffett and Peter Lynch, apply the Benjamin Graham test, run a DCF valuation, look at alternative models, and finish with a final recommendation.
Section 1. TE Connectivity Company Snapshot. So TE Connectivity, or TEL for short, essentially provides the hidden plumbing for the modern world. I mean, with 93,000 employees globally, they design the critical connectivity and sensor solutions that literally enable the flow of power and data. Whether we're talking about aerospace, electric vehicles, or the massive data centers powering the AI revolution, their parts are right there under the hood, making it all work. Now, at just over $203 a share, we're looking at a massive $58 billion market cap. Make no mistake, this isn't some speculative startup. It's an established, highly profitable juggernaut. But as any seasoned analyst knows, a great company isn't always a great stock if you end up paying the wrong price.
Section 2. Buffett and Lynch lenses.
So how does TEL hold up against the qualitative tests? Honestly, they've passed both of these distinct frameworks with flying colors. From Buffett's perspective, their economic moat is incredibly deep. Their parts are basically co-designed into client projects that last for decades. Because the cost of failure is astronomical, but the part itself is just a tiny fraction of the overall budget, TEL enjoys immense pricing power. Now, looking through Peter Lynch's lens, they sit comfortably as a stalwart, bordering on a fast grower, heavily driven by their dominant 30% market share in AI interconnects.
And Buffett focuses heavily on owner earnings. That's the actual cash a business generates after required capital expenditures. Well, in just Q2 alone, TEL generated a massive $680 million in free cash flow, tracking toward $1.3 billion for the first half of the year. That kind of rock-solid consistency, that's exactly what the Oracle of Omaha is looking for.
Let's apply Peter Lynch's absolute favorite quantitative metric, the PEG ratio. Here we get a score of 1.39. Basically, by dividing their 20.55 PE by their really impressive 33% adjusted EPS growth, the math suggests you're paying a very reasonable premium for their momentum right now. And sure, institutional ownership is pretty high, which is usually a red flag for Lynch, but their underlying growth likely overrides that concern for a true Lynch investor.
Section 3. The Benjamin Graham lens. All right, let's put TEL through Benjamin Graham's grueling defensive checklist. Graham demanded companies larger than $2 billion, a current ratio over 1.5, and manageable debt. With a massive market cap, a 1.89 current ratio, and a debt-to-equity ratio of just 0.42, TEL checks literally every single box. Add in 16 consecutive years of dividend increases, it's a defensive investor's dream come true. But here's where things get real. The math. We have to run Graham's famous intrinsic value formula. This formula, which takes the square root of 22.5 times earnings per share times book value per share, is designed to strictly cap exactly how much an investor pays for a company's assets and earnings.
And this is exactly where we see the friction between these different frameworks. Graham's strict math demands a price of $105.02. What does that mean? It means at today's $203 price tag, there is zero margin of safety. None. But remember, Graham's formula deliberately ignores things like intangibles, those sticky co-design relationships, and future tech cash flows. A strict Graham follower would absolutely pass here, but let's see what modern modeling has to say.
Section 4. Discounted cash flow valuation.
Moving on to our quantitative gauntlet. To build our discounted cash flow model, we annualize their first half free cash flow to about $2.57 billion. We're then projecting that out 10 years to capture all those AI and grid modernization tailwinds we talked about. We're applying a standard 8% cost of capital, or WACC, which is essentially what it costs them to fund their business, and a 2.5% terminal growth rate to discount it all back to today's dollars.
So what does it all mean? Under our base case assumptions, right in the dead center, the fair value lands right around $185. That suggests the stock is slightly overvalued today. Actually, to justify the current $203 price tag, you either need to assume a much lower cost of capital, around 7%, or you need aggressive, sustained perpetual growth well beyond 3%. It's definitely a high bar.
Section 5. Alternative Valuation Models.
Let's cross-check our work with relative valuation because it tells a fascinating story here. Compared to its close peer Amphenol, which trades at a whopping 38 times forward earnings, TEL looks like an absolute bargain at just 21 times. They share very similar moats, but the market is heavily discounting TE connectivity. Honestly, if TEL were to see its multiple expand just halfway to its peers' level, the stock would absolutely surge.
And we can't forget about the dividend. TEL pays out only 25% of its free cash flow. That means their historical 9% annual dividend growth is incredibly sustainable. When we run a dividend discount model based on that steady growth, the fair value aligns almost perfectly with our DCF model, landing right in that $180 to $190 range.
Section 6. Final recommendation and synthesis.
All right, let's bring it all together. What is the final verdict? Looking at our scorecard, TEL is undoubtedly a high-quality company, riding massive AI tailwinds. But blended together, we rated a hold at $203. We're waiting for a pullback closer to $185 for that crucial margin of safety. The business quality is stellar, for sure. Buffett would love the moat, Lynch would love the PEG ratio, and relative to peers, it's cheap. But we have to weigh risks like inflationary pressures on raw metals and some current softness in the North American commercial vehicle market. Ultimately, the intrinsic value models suggest the current price has already priced in a whole lot of perfection.
So, I'll leave you with this. As you weigh this incredible, rock-solid business quality against its premium price tag, ask yourself, is T-Connectivity's margin of safety wide enough for your portfolio right now? It is a phenomenal business operating exactly where the future of technology is heading. But as true value investors know, price is what you pay and value is what you get. I'd keep a very close eye on this one for a strategic entry point.